guys, welcome to my channel where we talk about all things real estate. Today I'm very excited because we are going to be talking about a highly requested topic, which is assumable loans. I get questions about assumable loans every single day from investors, buyers, sellers, so I just wanted to break down the process for you and answer some of the most common questions that I get around this topic. Loans that can be assumed are VA, FHA, and USDA. So if you are an investor, you can assume VA loans. And no, you do not need to be a veteran in order to assume a VA loan. For primary buyers, we can look at FHA and VA. So that would give you a bit of a wider range of properties to look at. The second question I get asked a lot is, what would my down payment be on these? So your down payment would be the difference between the purchase price and the loan amount that you are assuming. A really common question that I get a lot is the seller still liable? And no, the seller is not liable in assumable loans. So you would be assuming the loan and the seller would have nothing to do with it. They would be free and clear, so you would own, as the buyer, the loan and property would be in your name. So you wouldn't have to worry about the seller, and the seller does not have to worry about the buyer defaulting and that affecting their credit. The fourth question that I get asked all the time is, how long does it take? So these assumptions do take a little bit longer than a traditional purchase. So a traditional purchase is usually 30 to 45 days. However, with these assumptions, since you're getting the benefit of the lower rates, in my opinion, it's definitely worth waiting a little bit longer for, but it depends on the servicer. So depending on the servicer, it can range anywhere between 45 to 120 days. What I've seen the most is between 45 and 90 days, so it's not too bad if you end up saving a couple $1,000s on your mortgage. The question that I get asked a lot is, why would the seller agree to let the buyer assume their mortgage? So as a seller, if you are a veteran and have a VA loan on your property, you would be giving up your entitlement in order for the buyer to assume your loan if they are not a veteran. The benefit to doing this is that there are a lot of properties that are just sitting on the market and they are accumulating days on market, so they aren't getting any buyers. However, when we do market as an assumable loan, you can actually charge a premium for your property and sell it faster, because you would be able to find a buyer that would get a great interest rate, and you would also be able to get a little bit more money for your property. So there are a lot of benefits to doing an assumable loan. The first benefit I would say is obvious. You are getting a great interest rate. You can get an interest rate anywhere between 2% to 5%, which is great considering the fact that today our interest rates are about 7% at the current market rate. The second great thing about assumable loans is that the closing costs are actually less than a traditional loan, and then you do not need an appraisal. So that is also money saved for you, and the seller does not need to worry about their property appraising as well. Another great thing about assumable loans that not a lot of people look at is that you can actually have the amortization schedule transferred to you. So that means that if there is 25 years left on this loan that you are assuming, that would mean that you would take over the loan with the 25 years left on it. So you would be making more payments towards principal, because interest is usually paid off mostly upfront the first couple of years, because banks want their money quicker. So that's a great benefit to the assumable loans, because you would be gaining equity faster by paying off more towards principal.